All right, welcome back, Wookiees, to our first Wook in Review of 2023. This is Rod Alsman. I'm the Managing Director at Wook Capital Management. Just need to let everybody know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involves substantial risk of loss. We encourage investors to obtain advice from their professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. All right, with that mouthful out of the way, I just want to let folks know I have a family obligation that I'll need to ensure we wrap by 5:30. Obviously, it's the first week of the year, first Friday of the year. It was quieter this Wednesday when Joe and I had our market open mic conversation, so it might be quiet again. We may end up being done within about an hour or so, but we'll see. Just know that I'll have to wrap things at 5:30. It's 4:03 right now, but plan is to recap the Wook and Review newsletter from this morning. If you are not currently subscribed, you can follow the link in the Wook Capital handle. It is right there. It's a little newspaper.wook.gg. You can also type newsletter.wook.gg and be sure that you're signed up and getting those. Just to kind of recap a few things, we are going to spend most of the conversation today talking about 2023 market strategist expectations and what the market expectations are as of now, knowing that the future will almost certainly unfold differently than folks expect. 2022 taught us that. I do want to point out a few things on the Wook front, though. So we're going to continue to host these weekly spaces, Fridays at the close, these Wook and Review conversations that I host, and folks are always welcome to join. Our intention is to stay within the topics, the highlighted topics and the primary topics that we highlight in the newsletter. For the conversations on Fridays, we do have a market open mic that Joe and I host. I host on at Rod Alsman, my personal handle, on Wednesday nights at 7 p.m. Eastern, where it's really whatever you want to talk about. We don't have a set agenda. So the Friday conversations are a little bit more structured. We are going to be bringing back our Wook Book Club series that we had hosted two of in 2022. If you recall, Wook Capital just started in the beginning of 2022. So it was very much a pilot year for us. We certainly look to integrate learnings from the year, as well as feedback from those of you that completed our year-end survey. We appreciate that nearly 20 of you took the time out of your day to provide us some really valuable feedback. So I've been working on taking action items away from that, actually presenting to the team on Monday some of our plans for 23. But the book club series is something I'm very excited about. I think it's great because you can really be across the spectrum of knowledge when it comes to investing, and hopefully benefit from those conversations. We talked through Howard Marks, the most important thing last time. We settled on Seth Klarman's margin of safety for this coming Wook Book Club. I looked at the calendar, and Tuesdays, it actually worked out really well doing the last Tuesday of the month, other than Halloween at the end of October. And of course, around Christmas time, it always gets janky. I don't think we'll have any issue doing the last Tuesday of the month at 8 p.m. Eastern. I know we have folks joining from different parts of the world. My hope is that 8 p.m. to 10 p.m. Eastern does give a lot of folks the opportunity to join live. Stateside folks, I understand for Europeans, it's going to be late at night. And if you're on the other side of the world, well, Mr. Vestro, you just going to have to get up a little early. But that said, we do have the book club January 31st at 8 p.m. We'll go over margin of safety. I have a PDF linked. Fun fact about margin of safety, Klarman only printed a few thousand of these. So they're going for like $2 or $3 grand if you try to buy a hard copy. So please don't do that unless you're a collector. There's plenty of PDFs that you can find online. Let's pretend copyright law is not a thing for a minute. But I read it in 2022. I'm going to obviously read it again and refresh myself ahead of the conversation later this month. But Margin of Safety, I mean, at its fundamental core is a value investing book. And it's hard to refute the success that Klarman has seen in adhering to his philosophy. He laid this out in the early 90s. And in the decades since, his hedge fund Baupost has been a steady Eddie in terms of outperformance. The precise returns, I'm not a fund holder, so I don't have access to all the fund letters, but I've seen published anywhere from in excess of 15% annualized up to 20%, let's call it annual return north of 15%. But even more impressively, only 4 down years in an almost 40-year span. So the logic that he has, we'll talk more about it at the end of the month in the book club, but I think there's a lot of good lines of thinking that you can integrate into your investment process. Again, investment process. We're not talking about trading, at least with regard to that book club topic. They're two very different things. I try to be clear about that. So we're going to talk about that, at the end of the month. Between now and then, of course, we'll have a few more Wookin reviews. And we'll see what else. I'm going to share more about a new process that we'll be rolling out in 23. We talked about it a little bit last year, but we're still formalizing it, and I intend to kind of share that with more detail next Friday. Incremental programming that we'll be doing throughout the year. So with that said, let me get into the newsletter content. Again, if you're audio only, which is A-OK, Joe is going to be pinning different tweets to the Nest gear into the Twitter app. If you are interested in following along with my screen share that I'm recording and that we end up posting to YouTube, you're welcome to do so in the Wook Discord. If you're not a Wookie already, just type wook.gg and you can join the server. Again, our only barrier to entry is that you introduce yourself. You don't need to tell us a whole lot of detail, but we just want to prevent spam and bots and all that to the extent we can. So what's going on in the markets as we kick off this first week? A few highlights. We've got a continuation of these tech layoffs that happened on Wednesday. We got news that Amazon is going to be cutting an incremental, I guess it's an incremental almost 10,000 employees. They had announced cuts in November of about 10,000, and now those are up to about 18,000. So the total cuts are about 6% of their corporate workforce. I pulled this New York Times article kind of laying it out. The focus is on HR and retail, which if you think about how much hiring they've done in 2020 and 2021, it would make sense that as they pull back from hiring, they'll be reducing the size of their HR. And logically, as the consumer continues to be challenged, we've heard Andy Jassy, the CEO, talk a few times in the last few weeks in different settings about the challenged consumer and consumers flocking to being even more deal oriented than usual. And they obviously are not expecting the continued strength that they maybe had budgeted for in 2021 and 2022, which is a story throughout tech, right? Salesforce as well, laying off 10% of their workforce. And I included a visual just in the newsletter of, it was a Bloomberg visual. If you saw the Bloomberg story, just kind of showing, it's just pulling from the company filings, their workforce headcount over recent years. Obviously, they've done M&A over the years, so there's some growth just from the ongoing M&A slack, right? But you can see a pretty big downtick as part of this reduction plan from around 80 to 70-ish thousand. So that was still, though, not bring them back to pre-COVID levels. Pre-COVID is still 30, 40% lower from here. So I think that's kind of sums up a lot of these technology company situations. You see these headcount reductions, you see a lot of their share prices have come down meaningfully, but then when you step back and look over a longer duration, you realize, well, actually, maybe these are still a bit inflated, both on a headcount and valuation side. And we obviously don't know where technology will go in 2023, but it's been beaten down. And you definitely see an ongoing skew to laying off in this sector relative to the rest of the economy. So that, we obviously didn't include it in the newsletter since we write the newsletter up Thursday nights, but you saw in this morning's jobs report that the unemployment rate is now at the all-time low, or half-century low, 3.5%. So like that number in isolation doesn't mean a whole lot because you have to consider labor force participation. You need to consider, where's the trend going, so on. But the jobs are still being added on net in the economy. It was over 200,000, 223,000 jobs in December. So while it was the smallest gain in 2 years, still a big gain. And we still have this ongoing mismatch that, I'm not going to spend most of this conversation talking about the chairman of the Fed, but you've heard him for, in the multiple Fed conversations that we've hosted in the fourth quarter, and in the December meeting and also the September meeting, really reiterating this mismatch of labor supply. There is not enough supply. The Fed cannot address supply. The Fed can only address demand, which is why they are continuing on this path. The Federal Reserve's meeting minutes from that December meeting came out this week, and every single member indicated that they do not expect to cut rates in 2023. So that is a steep disconnect from the market. The bond market, the Fed futures market, more precisely, is pricing that those rate cuts are going to be happening by the second half of the year. So will be very interesting to see. I think for the soft landing crew, which we'll get to the 23 outlook and consensus forecasts in a minute here, but for the soft landing crew, there's been some good data points, right? This continued job gains with the wage growth cooling, this ongoing deflation in goods, and then it comes down to really what happens in services, as the chair laid out recently. It's he sliced into those three buckets. You've got the household related services, the goods. Talking about how the way CPI is calculated, you're still going to see the household related owner's equivalent rent, et cetera, rising, even though real-time indicators have shown that rolling over for some time. It's just how the math is done. And really what I think they need to see before they would be, they being the Fed, happy to take their foot off of the brake pedal, if you will, is wage growth. Needing to see that wage growth continue to come in line with what you would expect wage growth to be in a 2 to 3%, a normal, stable inflationary environment. You can't have average hourly earnings going up 5% and expect that inflation will get down to 2%. That math doesn't add up. So while the average hourly earnings increase in December of 4.6% was a move in the right direction, it was the narrowest increase since mid-2021, it's still, I think, elevated. And you heard some Fed speakers today, kind of sticking to the party line, if you will. So continue to need to watch the CPI, these jobs reports. On the other hand, we talked about, employment and labor and technology, yeah, they're feeling it, but a lot of sectors are still adding jobs, right? The net add, was 223,000, and we'll talk about manufacturing and services for a little here in the next highlight. So monthly, one of the, in my book, best data points of the month is the Institute for Supply Management's Purchasing Managers Index, the ISM PMI for manufacturing. So that those purchasing managers, right? These are the people who are plugged in, making the day-to-day, week to week, month to month, year to year decisions on what needs to be bought in what quantities, how to plan, and so forth. And those purchasing managers, fill out these surveys every month, and there's a bunch of different indices that go into this composite figure. But you can see in the visual that I shared, and if you're following along, this is a visual that Bloomberg just put together, pulling the ISM data. It's it's nothing special. You can Google the ISM data and just look at what that looks like over the last 5 years. Is the 5-year chart I'm looking at right here, and the way to think about it is it's a dispersion index. Dispersion, diffusion, I always mix the two up. Basically, if it's above 50, it's expansionary. If it's below 50, it's contractionary. So the manufacturing PMI ticked down again in December, and this came out on, I think it was Wednesday. So it ticked down to 48.4 from 49%. So 2 consecutive months of contractionary activity in manufacturing. And it's it's like a story of a few things going on. There's good news for folks concerned about inflation because the prices paid index has continued to fall. It's now below 40. So that is good from a leading, what's going to happen in the goods market in the coming future should be continued deflation in goods for a slew of reasons that we've talked about. Transportation costs being a big one, obviously commodities costs another one. Labor is the one that's still not really coming down, but that's not the one that caused the moon missions that a lot of these commodities and transportation services saw over 2021 and 22. So continued normalization of supply chains, I think, is what you can read through from this month and preceding months manufacturing PMI. The new orders index. So this is I think the concern. I think at some point in the next few months, the market likely shifts its concern from the Fed to the actual weakness in the economy. Now that may or may not happen. That's my prognostication. But when you look at the new orders index continuing to fall, and this would imply, right, that, well, if there aren't a lot of new orders being made, if new orders are contracting, then that's a reduction in activity. Well, if the employment gauge rose to a 4-month high, for example, so obviously manufacturing jobs are still being added for now. But if new orders continue to stay so weak, the implication there is that, well, you're probably not going to need all that labor that you're adding if new orders are declining. So continue to watch that new orders index, but it's down to 45.2, which is fairly contractionary. And there's a lot of fiscal support in manufacturing still. So within that space, there's definitely some bid, if you will, for demand in terms of a lot of we talked about it. I think it was in the 12th Wook Review. We talked about the CHIPS Act and the Inflation Reduction Act and how many hundreds of billions of dollars of plant-oriented investment for chip manufacturing in Arizona and for automotive, for EVs in battery plants throughout the Midwest and the South. So those are obviously there. Those dollars are out there, and that'll help to prevent it from being maybe a hardish recession if this trend continues. But yeah, I also would note that the services, the ISM non-manufacturing PMI came out this morning, so we didn't have it in the newsletter, but U.S. services industry activity contracted for the first time in more than 2.5 years in December. So the services PMI was surprisingly weak. It came in at 49.6. Again, it's contractionary when it's under that 50 threshold. And as I think we talked about, right, services are the bulk of the economy, the consumer consumption of goods and services, with services being roughly, 2/3 of the consumer activity. GDP is consumption plus investment plus government spending plus net exports, and that consumption is 68%, and of that 68%, 2/3 is services. So if services is now contracting, goods has been now contracting. It tells us that at least based on these survey metrics, right, these purchasing managers looking forward, is that there is continued slowing in the real economy, which is what the Fed does want to see, right? They want to see slowing in wage growth, particularly. So it is still, I think it's more conceivable now than it was 2 months ago, based on recent inflationary readings and some of these metrics coming out in the last few weeks, months, that soft landing thesis is, there's a real path there, right? The Fed chair was asked recently about whether he sees a path, and I think think fairly, he can see a path to that, even if it's historically uncommon and still not the base expectation of most of the economic prognosticators, which we'll get to in a minute, that could in fact happen. You know, soft landing being that GDP growth remains positive. We do not see a classical recession wherein growth becomes negative. And that's what the Fed has in their summary of economic projections that we reviewed last when the December meeting came through. Right, they still expect that GDP will be below trend, below what they would expect. The economic capacity to be in the long run growth rate of which is like 1.8 ish. Which is a function of employment growth and productivity. So that they're still thinking there will be below trend growth, and I think it's safe to say that the prospect of that has risen somewhat. But these things happen quickly, right? Once you start to see, if you start to see a real deterioration in activity, will you start to see a meaningful uptick in acceleration in layoffs, and then what? Becomes the question. It's typically not common that the layoffs rise slowly. I know there's the SOM rule where once layoffs, I think it's once layoffs rise by a certain percent, that you're assured to have a recession. But regardless, cover a couple of those metrics there, the manufacturing and services PMIs. Last highlight before we talk through the 23 outlook is Tesla. It's really, obviously a stock that a lot of retail is very interested in and has been interested in. It's made a lot of folks a lot of money, lost a lot of folks a lot of money. It really comes down to when your entry and exit points were. But Tesla's had a very wild last month or so here. The stock is down almost 40%. I guess it's up today, so it's no longer down that much. Markets obviously rallied today meaningfully on the weaker wage growth figure, and kind of these data points showing that there is more of a prospect for that soft landing. But anyways, Tesla's down from almost a 1.3 trillion market cap that it peaked at to under $400 billion market cap. Now, on an absolute level, $900 billion of market cap going away is massive. But then when you look at the $400 billion market cap in the context of other automotive original equipment manufacturers, it's still extraordinarily inflated. The stock still trades at a next 12-month EV to EBITDA of almost 15 times after today, which is just in its own league relative to other automotive OEs. And it's hard to parse exactly what it is. I point out that you've got increased concerns of competition, right? Wherever you are in the world, if you're in China, you've got a lot of these lower cost competitors. In North America and in Europe, you have the legacy OEs that are bringing products to market, and of course other new entrants that are looking to claw their way in. Demand getting hit. We talked about this several times before, that as rates have risen meaningfully, the cost of owning a Tesla or any premium priced automobile has risen meaningfully. Your monthly payment on a 3% loan versus a 7 or 8% loan, it's massive, and that demand is getting hit. And then there's all of Elon Musk's kind of wild antics. He's obviously got a lot of folks who adore him, and there seems to be more people that have been spurned by him of late. There was a great Bloomberg story, Joe. I think you just pinned it, which was yesterday, talking about, the headline is "The Many Forces Fueling Tesla's $860 billion tumble." So I said 900. Okay, I was off by a couple billion, but in the same ballpark. By Isha Day in Bloomberg. And yeah, she points out it's still by far the most valuable automaker in the world. Ford, General Motors, Stellantis, which is Chrysler, Toyota are worth the same combined. And yeah, I think it's a combination of, we've seen a lot of these tech valuations. If you think of Tesla's value more like a technology company, less like an automotive OE, which is how it trades, has traded, it makes sense that it would fall, but it's certainly fallen more than that index. She points out that the FANG Plus, which is your Facebook, Amazon, well, Meta, Amazon, Netflix, and Google, plus a few other large mega caps and large caps, is down about 40% over the past year, which relative to Tesla's nearly 60% over the last year is pretty incredible. And it's even more stark when you look at it over the last 3 months. Tesla down 59% over the last 3 months, whereas FANG Plus is down 6.7, and the S&P is up 6.7. And again, this is data from yesterday. These numbers aren't precise, but just again, kind of talking about the absolute magnitude. I think it's safe to point back to April when Elon Musk opted to sign a contract to buy Twitter, and things changed a lot. And it's not all his fault, right? And it was clearly not the most thought out move, but I don't think he or many others, I certainly didn't expect interest rates to move the way that they did. It was a leveraged buyout. There's a lot of debt. The debt, the banks that are holding the debt are going to take big losses. They're trying to offload the debt. You got Elon trying to sell equity to retail shareholders at the same valuation that it was when he agreed to buy it in April, which is kind of laughable when you see that the debt is trading at, or not trading at, but the implied debt valuation is at, like, depending on the tranche you're looking at, 60 cents on the dollar or less. So for him to try and get the same equity value, I think is pretty bold. But he's a great salesman. It's irrefutable. He's one of the greatest of all time. So remains to be seen what happens with Twitter, but with Tesla, at least, they're clearly facing challenges they've never had to face. They've never been a scaled OEM heading into a recessionary environment. And while the automotive space has some different tailwinds than it has had in preceding recessions, right? The inventory levels are still fairly low industry-wide because of all the underbuild, because of all the chip constraints that many other OEs have faced. So even though demand is likely to fall off because supply has been fairly constrained, you could see that automotive may not take it on the chin as much as they might in a traditional recession. But for Tesla's valuation, it goes back to the whole, Tesla's always been a story stock. The story is that they can grow at 50% for many years to come. And with the fourth quarter results coming in earlier this week, they grew in the 40s. But when you consider all these headwinds that they're facing, it does not look likely that they'll achieve that really high target. And if you're not growing at that sort of rate, it's harder to justify these elevated multiples. So clearly, there's also been the fact that Elon Musk has sold $40 billion worth of Tesla stock over the last year. So while he continues to assert that he sees a path for it to be the world's most valuable company, his words and his actions seem to deviate from one another. So it's just one of those things. It's hard, it's one of the most valuable companies in the world. I've seen that there's estimates that it comprises north of 10% of the average retail investor's portfolio. So the implications are pretty meaningful if there's a massive wealth wipeout. Because you could argue, right, Tesla's still many multiples above where it traded before COVID. And while things like the Inflation Reduction Act and other both domestic U.S. and international policy decisions between now and the last 3-ish years have pushed things in the direction of EV adoption, that doesn't necessarily mean that Tesla ought to be worth however many multiples of the other car companies. And we'll have to continue to monitor and see what happens. The last topic then, before I'll kind of open the floor up, and I'd love to hear some of the folks who are live on the call if they have thoughts on 2023, especially where they differ from the kind of consensus viewpoint. So Bloomberg captured over 500 different Wall Street strategists' thinking and inputs. I tried to use archive warrant.ph to get a link that's shareable. Unfortunately, the filtering tools do not work when you do that. So they put it out on Jan 2nd, and the headline is "Here's almost everything Wall Street expects in 2023." Look, I'm not trying to pump Bloomberg. I think that they are worth. I pay for the subscription. I think that they're a good news source. Generally speaking, they oftentimes get good insights. But yeah, if you don't have the paid one, unfortunately, you might not be able to read all these. But I included in the write-up, kind of what I would summarize the view being. And I note that the consensus calls for a recessionary year globally, with Europe and the US at greatest risk of seeing real GDP growth turn negative. Wildcards include a Fed pivot to rate cuts, which, as I just noted before, none of the members in the December minutes were in favor of that. If there's a successful, faster China reopening, which just today we got news that the Pfizer drug treatment for COVID is being approved in some capacity in China. So I've seen on social media a lot of folks commenting, how quickly they've opened things up. It's not to say that the disease is gone. There's been a lot of people being sick and in China, and there's likely going to be a wave of deaths. But once this kind of flows through the populace, the expectation then is markets are forward-looking. Markets are now seeing and pricing in a more resilient, productive Chinese economy in 2023 than had been anticipated just a couple of months ago, when COVID zero, was still a blanket on the economy. So it's depending on how fast that reopening and how many stumbles there are, or if China exports some new variant to the world that starts to cause more issues. I know that this season's flu virus, for example, I've heard is one of the worst flu seasons in many years. I had a call canceled yesterday because the New York-based financial services gentleman I was going to be meeting with had the flu. So yeah, it's there's uncertainty on that, but I think that's a risk to the upside, is that Chinese reopening going faster and more smoothly than folks had penciled in a month or two back. There could always be a resolution in Ukraine. Putin could decide that, he had maybe hoped that there would be a cold winter and that Europe would be really struggling with their natural gas and their power needs. And, there's been a remarkably warm winter so far, and natural gas prices have come way down. And maybe that goes into Vladimir Putin's calculus of how he treats the next steps with regard to his Ukrainian invasion. Who knows, right? These are some different risks I just tried to lay out, and that I think I've seen folks talking about to the upside. And to the downside, right? I guess I won't belabor that point, but I'll kind of read off a few of the different analyst expectations that caught my eye. And then, it's 4:35, so I think I'll get done with this in about 5-10 minutes, and then kind of open the floor up for discussion about it. I know Joe is, again, pinned to some of these, so I won't read them all off, but I think it gets back to it all gets back to expectations, and what are the embedded expectations in prices of these different securities in the market. And when you think about a risk-free rate that's around 4% still, and we talked about in the last book club, we incorporated Howard Marks' Sea Change memo from earlier in December, which the reality is, if you are positioned wholly expecting the Federal Reserve to rapidly return to a zero interest rate policy, then you might be biting off a lot of risk that does not come to fruition, because while the Fed has said that they won't, the market is pricing it that they will. And if risk-free rates are at levels like they are now, even slightly lower, Marks notes a 2 to 4% range in his memo. I think the 10-year is, I know the 2-year was way down today. The 10-year is back under 4%. It's back down all the way to 3.56%. It dropped 16 basis points today. So I know the 2-year dropped meaningfully today as well. So again, markets are pricing in these cuts. The 10-year being so far below the 3-month, right? It's almost like, I think, a full percent inversion, which, as I think we've talked about here, just because it's inverted, while historically that means recession, with all the noise and bullwhip effects kind of going on, I don't think it's as easy to just chalk it up and say it's a sure thing. But again, these yields are much higher than they were. If we kind of zoom out, over the last 5 years, again, it's still the highest point, in the last 5 years or so, and really you've got to go all the way back to pre-Great Financial Crisis to see 10-year yields at these levels. So it is a sea change, in Mark's words. If you consider that risk-free rates may remain at or slightly below these levels for a period of time, well, then equity valuations appear pretty stretched. And that, I think, is the general consensus of these strategists. Beyond the valuation discussion, for example, BNY Mellon notes that with Europe and the UK in or approaching recession, China slowing sharply, and the US needing one to bring inflation back to target, it is our belief that global recession remains our most likely scenario. We give it a 60% probability. Again, I'm not going to read them all, but almost all of them kind of lean toward recession in Europe, UK for sure, the balance of Europe probably, the US probably, and that, again, we don't know if that's really going to happen or not. But if those things do happen, and you look at equity values, at least domestic equity values, the forward earnings multiple on the S&P 500, which is of course large caps, is still around 17 times forward earnings, which, while that is not rich over, maybe looking back over a 10-year window, as I just said, if you look back over that 10-year window, the risk-free rate over that 10-year window has always been far lower than it is presently. So unless you expect the risk-free rate to drop meaningfully, then maybe, and that there will be a soft landing, then you could argue that things are perhaps fairly valued and perhaps there's some upside, right? If you are of the view that risk-free rates will come down below 3 into the 2 and change mark, and that earnings recession will be minimal or non-existent, then yeah, I think that's fair to say that things are fairly valued-ish if you believe those things. If you don't, if you believe like me that there's likely to be revisions downward, more revisions downward. There have been some over the last month or so for 2023 earnings estimates. I think that the next thing to look for is as companies come out in the fourth quarter. We've obviously wrapped the fourth quarter for most companies that operate on a calendar year. They'll start reporting in late this month and throughout February. And when they start issuing guidance, I think that's when you start to see that maybe what they've been warning of, some of these companies like Amazon for some period of time, and maybe the stock prices in some of their cases have already gotten those expectations baked in. But that's where I think it's very important to remember, what are the expectations? What are the implied expectations based on the valuation? And at least market wide, I think that expectations are still fairly high relative to what folks expect to happen in the real economy. But as with all things, we have to see what happens, and we'll continue to monitor and kind of watch and pay close attention, throughout these weekly discussions. And as we, do different Fed programming, I'm sure we'll continue to cover. I plan on continuing to cover because it's something I do on a daily basis anyway. And if I can incorporate that and make it a good use of folks' time, then I'll continue to host the Fed-related conversations as the Fed press conferences go on and so forth. So, yeah, I think this chart about the spread between the analyst estimates or the strategist estimates really kind of sums it up. You've got over a 30% spread from the high-end estimate to the low-end estimate. And looking back 15 years, only 2009 had a wider spread. So there is a huge range of implied uncertainty around where the most bullish versus most bearish analysts see 2023 going. So it's fair to say, we know a whole hell of a lot of nothing about what's going to happen in the coming year. We know what we know what's priced, we know what expectations are. But we can agree that expectations are kind of all over the place when it comes to how the price of the S&P comes down. Even if the base case is generally for there to be some recession in these markets, what that means for asset prices, obviously, we still don't know. So with that, that's the bulk of all the prepared content that I had. Now that I've spoken for 40 odd minutes, right, let me quiet down. Anybody who wants to, again, come up and chime in on what they think is going to happen in 2023 or beyond is certainly welcome to. But Joe, I know you're in the car. What do you think is going to happen in 2023?
Can you hear me, Ryan?
Yep.
Cool, yeah. I mean, it's most likely going to be recessionary. If you look at all these analyst expectations, I'm sure, Rod, you may have picked some that you resonated with. But I think overall, and look at Vanguard, BlackRock, I'm not going to pretend.
Breaking up a little bit. I know you're driving in the mountains. The volume's a little low, but yeah, I mean, look, clearly there are some people that aren't calling for a recession. I'd say consensus because that seems to be the bulk of the views. I'm now sorting by growth just to see what the commentary on growth is, and I think a lot of it, a lot of the growth comments are weaker prospects for growth in 2023. Not that there will be an acceleration in growth, and I think this is where the real challenge is. And let me just pull up Yardney. He always has, I think, free, easy to access research that his team points out. I feel like I'm beating a dead horse, but when you look at earnings that occurred in 2020, 2021, 2022, in the context of how elevated margins and S&P, profits were, it's hard for me to see a lot of upside risk, I guess. And I'm happy to be wrong, right? I'm not saying I hope that the economy doesn't do well. I'm just saying in the context of, again, the S&P is, of course, 500 is, of course, large caps. So we're not talking about small and mid caps here. But the visual I have up is, if you just Google Yardney earnings forecast, you can pull it up. The stock is from the 3rd, so it's a couple days old. But the visual I have is the S&P 500 operating earnings per share. And you can just see that typically if there's any form of a slowdown, earnings decline. From 2015 into 2016, right? That earnings declined, almost 10%. It looks like, and for obviously the great financial crisis. That's one thing I'll point out. No one is really calling for anything on par with that. And while there could be some sort of a black swanish event with what's going on in Japan, right? They've kind of had to back away from yield curve control. They've shifted their range up from 25 to 50 basis points on the Japanese government bond, the 10-year. And they already have had, I think, a couple of emergency buying interventions this week. So they're like one of the last ones trying to hold things so low. So if some funky things happen in like foreign exchange and credit markets, I mean, that's above my pay grade. I'm not trying to call for any of that. Those are things that I kind of am looking at and seeing happen. But again, when I think about the earnings, because in the long run, and if you believe that markets are generally rational, that the earnings per share are going to be what drive the valuation, and what the appropriate multiple on those earnings are is, of course, up for debate. The estimates are still, the consensus is still calling for $230 in EPS versus around $220 for 2022. So 230 over 220 is almost a 5% earnings growth is kind of what is being still estimated by sell-side analysts. And in the context of a slowing economy with all of these headwinds, I don't know. That just seems awfully uh, bullish. And while those estimates have been getting marked down, I still think that there will be a lot more markdowns to come in the ensuing several weeks here as we get into the fourth quarter earnings season. But that's my view. I'm over personally in my personal account have a higher than normal cash allocation and am underweight equities. And I know while we haven't discussed Wook's positioning in any sense of detail, I will note that Wook's cash allocation is far higher than it would be in a steady state environment, if you will. So, yeah, I'm curious if anyone who's on the call has thoughts like how they're positioning themselves. Again, if they're maybe they're very bullish and they're seeing something differently. Would love to hear that. Um, but yeah, it's 4:48 again. I can keep this going until 5:30. I have to make a hard stop at 5:30. But really, I would love to hear some different thoughts. Otherwise, if there's any areas you want me to explore or chime in on, I'm happy to. But if not, if it's a quiet Friday and there's only a handful of folks in the room and a lot of people are still kind of wrapping up their holiday vacations, we can get done at 5 otherwise. No need to hear me talk just for the sake of it. Although I hope that the audio sounds better. I got a lovely gift for Christmas of the new AirPod Pros, and I will say the noise cancellation on these things are quite incredible. So pretty impressive. But it's quiet.
Ron, can you hear me?
A little bit.
Alright, sorry about that. So we have a write-in message question for you over on Discord.
Okay, yeah, I see it. Yeah, Dr. Love, Dr. 22 Love, good cue about the mega packs. I mean, so okay, Tesla, like the energy business is such a tiny contributor to the overall valuation today that while I think stationary energy storage is absolutely a major growth area, I don't know the market well enough to have any real deep insight into like how much better or worse Tesla's product offering is relative to others in the space. I mean, obviously, there's been like the headlines of in Australia these major deployments that they've done of these stationary battery packs, and I've followed energy markets for some time, and when you think about building solar or wind, the idea of pairing it with 4 hour or however many hour backup battery packs, like those, they all logically make sense. However, I think it for batteries, and I think that this is if you're a Tesla. I don't want to say for Tesla bull, but I know that what I had heard from my former, I don't want to call him CTO, but when I was at Ryder, he was the main contact point with Tesla, and he was the one who kind of got me the opportunity to sit in the Tesla Semi in 2019. It becomes like a math problem because if you truly believe that you're supply constrained, then it comes down to where do you deploy the batteries in the most opportunistic manner. And it was like you could put those batteries, you could put 3 or 4 or more Model 3s worth of batteries into a Tesla Semi. But how much gross margin are you going to get on a Tesla Semi relative to selling those 4 or 5 Model 3s? Not as much. So from a pure Tesla short-term thinking, at least perspective, I know that was part of the logic. That was part of the spin, whatever you want to call it, around why the Semi was really backburnered so much, is that they would prefer to sell the limited amount of battery production that they can make in the most profitable manner. And I know that lithium iron phosphate LFP, they've been doing that more in their Chinese builds, and I believe they're using that for stationary storage as well. So the LFP doesn't have cobalt, doesn't, I don't think it has nickel. So I think that the if they're doing a lot of LFP and maybe they're not as supply constrained with LFP, then it'll be interesting to see how much the mega pack business ramps in 23. But like I don't have any real deep insight into how they're positioned. I'd love to tell you more. If anyone on the call does, would love it if you chime in. But hopefully that's at least something to chew on. Yeah. Um, any other questions? Again, if you and I know Dr. Love, you're the only one in the in the live stream, but if you're in the Wook server, you can obviously type a question in the spaces. You can also just type a question below or within the space itself that Joe or I can see, and I'm happy to respond to. Um, trying to look at 5 different screens at once. It feels like. What sectors do you see undervalued right now? Are you looking at any telecoms right now? It's a good one. That's a good question. I've been looking in that telecom space, and a lot of the question marks that I have are around things like a lot of them have a big debt burden. So we're talking about stuff like maybe the cable companies. I think Dr. Burry had put a position on in Charter or Comcast, one of the two. You think about Verizon and AT&T. You know, some of them are a little more utility-like in their cash flows, right? They're pretty consistent. I think that the concern I've seen folks in Twitter, for example, who I know are like TMT, telecom media uh, analysts, and kind of talking about like with I guess the bears talking about with telecom that you're going to keep investing in fiber and keep investing in infrastructure and spending all this money, and are you ever going to see a reasonable return on that spend, especially in a context of a world where we're going toward a lot of innovative ways to transmit information at high speed, like low Earth orbit, satellite networks. I mean, again, love them or hate them, SpaceX does have a massive ramp and satellite array that they've deployed over the last couple of years. They're not the only one, deploying different low Earth orbit. I know there's AST, Space Mobile is a DSPAC that's kind of trying to use low Earth orbit satellite network to basically be what is it, a mobile network operator, like so they can basically use satellite low Earth orbit satellites to transmit to cell phones and basically allow people to access the internet at lower cost through a mesh of satellites as opposed to maybe your cell phone towers. So like I guess the question mark for that space is like the capex that's going in the ground today. Do you get a return on that? And given that a lot of them have a lot of debt, you look at the debt structures and is it fixed or floating rate debt? And if it's floating, then that's worrisome given how high rates have risen. So I don't, I worry that some of that is a value trap. I don't personally have any investments in the telecom space right now. I've talked about GoGo in the past because I think GoGo is an interesting like communication play. For those who don't know, GoGo is purely business aviation today. They sold the consumer business to Viasat, one of the geo sat companies, and now GoGo's business is we put a small antenna on your private Embraer or whatever, your private jet, and then you pay, for data. So they have as I mentioned SpaceX earlier, and SpaceX isn't really targeting the smaller business jet space that GoGo plays in, and also the cost is higher for SpaceX. So GoGo I think is interesting because they have the they also have, I think, what is it, radio frequency. They have that like in North America at least, they have the benefit also of having kind of the ground network that enables them to perform well, and they're the market leader currently. So like, there's clearly risks to their business, but I have a small-ish position in GoGo. I think it's like 2% of my personal portfolio is allocated to GoGo currently, but that's my only telecom type play. And again, it's one of those that people hear the name and they immediately write it off as something, and they maybe forget that the business is actually fundamentally different now than it was just 2.5, 3 years ago. But I find that as an interesting play, because you're basically, once the infrastructure is built, right, you're basically getting really, really attractive free cash flow generation. I think that the free cash flow conversion, like I know they're targeting in 2025, like 45% EBITDA margin. So it's pretty darn high margins, pretty nice free cash flow conversion. But they've been investing in a 5G network, which will likely be the last, I think, major network build out. But yeah, and, to go back to the question of what sectors do I see undervalued right now, I'll just pull up a visual with all the equity sectors here, and let me zoom out over 5 years. It's interesting because if you look at 1 year, energy's obviously blown things away. And yeah, if you expect a global recession, well, you should probably avoid energy, right? That's I guess the gut reaction. But I think a lot of the energy space had, there's been so much chronic underinvestment, and like all the energy bulls have talked about this for a long time, that I don't know that you ever see energy go as low as it did in 2020, and it's obviously risen a lot since then. But generally speaking, the valuations in energy are still really not demanding. But the question mark is, right, energy is generally a commodity business, and when commodities are weak, if there's a global recession, then prices fall. But I still, I put out a poll. Maybe Joe, you can find it on my handle. I had put a poll out asking people what percent of their portfolios were allocated to energy, and it was like half of them were less than 5%, which that's about what the S&P 500 weighting for energy is. So it's not out of whack with maybe what you would expect, but just I think energy could be interesting. And if there is in fact a soft landing, right, then yeah, I mean, that energy seems like a great play. Consumer discretionary has obviously been beaten up a lot. I do not want to say that it's undervalued, but I do think as you get into the middle and back half of this year, there's a lot of consumer discretionary that's going to be left for dead. Now that said, there's obviously a lot of risk in consumer discretionary. We saw the news just yesterday of Bed Bath Beyond likely filing bankruptcy. Party City, I think, today announced they'll be filing bankruptcy or pursuing that. And with how, again, their whole rate situation and what the debt situation, you need to definitely get, you need to be particular about each security, because if they have short-term maturities and they're just not generating the cash, definitely would be worried. Obviously PLBY has a rights offering going on right now, and they may have to sell some assets. I know Brian McGough at Hedgeye believes they will end up having to sell Honey Burdette as this rights offering appears doomed to fail, which, given the valuation today, any sale of Honey Burdette, even at half, even at a third of what they paid for it, given that they bought it with equity sold at 43 bucks a share in 2021, I'm inclined to think that just taking that kind of insolvency concern off the table, I mean, that particular equity is now shorted about 30%. I think that would be accretive, but that company has a unfortunately a poor leader who is very stubborn. So let me not get on a rant on that one. Zal, random filler question. Yeah. ASTS, I know a bunch of guys, including a guy who works in the industry, who's pretty bullish on the technology. Now, I know they just did an offering to raise more capital, and I don't intimately know their cash burn or their runway. But when I think about, you know, upside versus downside, that's one where, right, it's not like it's a fraud. Like some of these SPACs were obviously just straight up frauds. And this one's now down, I think, around 4 and change. So, it's, I guess, relative to some SPACs doing fairly well, only being down 50 something percent. But yeah, I think I've heard good things from people that are knowledgeable about the industry, about ASTS. Full disclosure, I have a very small cash secured put position on it because I found it had gotten pretty beaten up. A lot of stocks got pretty beaten up in late December, and that was when I opted to write some January CSPs on personally. So I keep watching it. I'll probably, if the price stays in the low mid single digits, I'll probably keep rolling and trying to monetize and possibly build a small position. But it would be less than 1%. Again, it's inherently speculative pre-revenue situation there. But I do think the technology has merit from folks who've done more work on the space than I, is how I've heard it. Let's see. Yeah. If you guys keep your posts coming, I mean, I'm not really considering energy shorts this year. So just so you know, Dr. Love, my core energy holding is EOG. So EOG is the exploration and production company who, from most of the, again, people smarter than me about the industry have kind of pointed to them as a best in class operator, very well regarded. They have a very diversified portfolio across North America, chiefly in the U.S. They have some gas production in Trinidad and Tobago, but and for me, I own that EOG with no hedges. I have no written calls or open puts on it. And that's for me a core energy holding because you could always own the XLE, right? Um, I am not a huge fan of indexes as a rule. I know that maybe is contrarian, but I prefer to actually know, have a little more direct control over what I'm buying. And XLE is, whatever percent Exxon and Chevron, right? It's mostly Exxon and Chevron, and then you're getting a handful of the other things come along with it. So, I really don't feel like there's fantastic energy shorts out there. I know somebody in the GME DD server was looking at Schlumberger, and I know that the oil field services companies, um, you know, yeah, if there's a big slowdown and price, oil prices plummet, then yeah, they'll get hit. But I don't know that I think they're so stretched that like I would really want to lean on any of them short, um, at least without having any deep insight into the individual, name, right? Um, yeah, as you said, with China opening, that's a lot of incremental energy demand. So I I don't know. Again, it's one of those. It's a horrible idea to short something just because it went up a lot. Think about how many people lost everything because they tried to short GameStop in January of 2021, right? You should have a much more thoughtful thesis than just that it went up a lot. I'm not calling you out, sir. I'm just saying, generally speaking, I know a lot of people are like, oh, energy's up so much over the last year, therefore, it must come down. But that's where I say, when you just look at the absolute valuations in energy, I think there's still, they're not demanding. Clearly, if there is a bad global recession, energy likely is negative on the year. But unless you're really betting on that, there might be better things to bet on than just energy, right? Maybe you look at some of the weaker discretionary stocks that, if there really is a bad recession, they might not survive. I know Wayfair, for example, right? Bed Bath is obviously going to likely file, but Wayfair is another one that, in that same space of consumer, discretionary home goods, Wayfair has never really been able to make money, even in, a once in a lifetime, if you will, environment. They have a lot of debt and convertible debt, I know, coming due. I am long Overstock, so let me be clear. I've taken it on the chin with Overstock, but that's again in my personal account. We're not talking about Wook's holdings there, but I think Wayfair has a lot of downside, and depending how much it rallies, if this January rally that happened today has some legs to it, if some of these we call them shitcos rally too much harder, like a W, it might be attractive to either enter a short or put on some sort of a position that would benefit from a decline in price. Um, yeah, again, folks, Brian, sick. I see Joe added you as speaker. Sorry, I'm not looking at that screen, but Brian, if you want to chime in, please go ahead.
Oh yeah, appreciate it. Yeah, just going back to sort of throwing out an opinion on the market for 23. I thought today was pretty interesting. It seemed like the first time in a while that good news was like good news, and everybody keeps waiting for the pivot or the Fed pause or what have you, and I'm not sure if that was options expiration or too many people got too far on the put side of the boat. But kind of, I think next week, may shed some light on the general trend here in the first part of the year. My initial thesis was we were going to bottom, the first half of this year, and kind of go from there. I do believe in somewhat of a soft landing. Things look pretty strong, even with the rates where they are, and I think the economy is good. I know it was a lot of raises in a short period of time, but historically speaking, 4% rates and 6% mortgage is not outlandish. It's outlandish for the last 10 or 15 years, but
Yep.
It's not outlandish in the grand scheme of things. If anyone's as old as I am, and bought houses when they were 6.5% and 7%, that was pretty standard. So
I think that the challenge that I see, Brian, is when it comes to housing, at least, and obviously every market's local with housing, but on a national level, housing prices compared to pre-COVID are still like what 30-40% higher, and obviously rates pre-COVID were not the 2.5 they got down to in zero interest land, but they were higher than 2.5. They were maybe what 3 to 4, but they were lower than what they are now. So now you got rates at 6 and change, which to your point in a long term absolute basis isn't all that high. But I think that's where the other side of the coin is that if rates have risen that much that fast, prices ought to come down a lot more than they have. And clearly housing is in a recession, that sector at least. But you know, who knows how? Maybe they only have another 5% to go. And I think we talked about it in a call or two ago. We talked about the different estimates out there. Like, the National Realtors Association never going to say that prices are going to go down. I think they were like calling for flat in 23. I think at the low end of the range was minus 20% from I think it was KPMG. So let's split the middle and say minus 10%. I mean, I don't know. That still feels light to me, knowing that means that nationally, then housing prices are still, would then still be 30-ish% higher than they were pre-COVID. And like when you zoom out and look at the Case-Shiller over 20-30 year period, it looks a lot like a bubble. I'll pull the graphic up while we're talking about it, but not to say you're wrong. I mean, I agree with you in the context that a 6% mortgage shouldn't be, something that people are like, oh my God, this is crazy. Because, 20 years ago, maybe 30 years ago, I guess people would be like, oh man, 6%, that's awesome. Um, but I think that's where, in the context of prices, it still seems stretched to me, at least.
Yeah, I don't disagree, and I think they might have some more room to fall. I think the situation there is that, you know, only a handful of people, because of low inventories, were actually able to purchase a home, in 21 and in the first quarter of 22. And so most of this is paper gains. I think most of it is people own their house since 2015. Yes, their house went up by 30 or 40% in a 2-year stretch, but so did everything else. So, they didn't necessarily sell and try and buy another house. And maybe now their house will go back to a more reasonable, price where it only went up 15% over those 2 years or 20%. And they'll still be in the same position they were before. They were in a locked in 4% mortgage from 2015, and there's just low inventory, and so not that many people are going to get burned by the bubble. I don't think there's.
Well, what I find
I don't know.
interesting is you've got folks who locked in. Let's say they locked in at 3%, and maybe the price is now down. I don't know. Let's call it 10%. I know prices are down about 10% from the June peak per the Case-Shiller data. Like for the folks like that, it's going to be really difficult because they need to sell the house, take a small haircut, and if they wanted to move, I guess my concern, like broadly, when I think about housing now, is you're going to have a cadre of home buyers who, bought, they were fortuitous with rates, but if they stretched themselves, if they didn't put a lot down, they now may find themselves trapped in those homes, and they can't relocate for work and so on.
I would love to see the numbers, and I haven't seen anyone talk about it. I haven't seen the numbers. Just how many homes were sold in 21? And I guess it could even go back to the last quarter of 2020. Last quarter of 2020, 21, first quarter of 22, that seemed to be sort of the peak bubble when the real increase happened.
Yeah,
Quick
Google 2021 annual existing home sales, 6.12 million, which was the highest level since 2006. And obviously there were some new builds in that.
What percentage is that of the total homes in the United States? Do you know what I mean?
Yeah. Offhand, I'd have to look it up.
I mean, my sense is that it's a small percentage. I mean, it sounds like a large number, but my sense is that
you're sure, in the context of all housing stock, it's a low percent, but in the context of how much of that turns over on a yearly basis, clearly, if it was the highest in 15 years in 21, it was somewhat inflated by rates, and now obviously it's much lower, and is it going to get, is it going to swing too far in the other direction? Probably. I've been looking to buy a home for years now, and I'm obviously now in the Tampa area, but when I look at how much prices still are elevated versus pre-COVID, and Florida obviously has its own kind of quirks, given that there's a lot of net immigration to Florida and continued growth and development in a lot of the major metros. So I don't want to lean too hard on saying that Tampa is an embodiment of a national housing situation, but I know that the affordability is worse or close to the worst it's ever been, and the percent of your median person's income that goes to housing in Tampa is like over 36, 37%. And I know nationally it's in like the 30s. So I know that the affordability measures are still very bad, very unaffordable. To me, it's just a matter of the only thing that really solves that is prices continuing to drop. And I know that the 30-year fixed rate mortgage, is going to be a spread above the Treasury. So as those yields, if those yields keep dropping, the fixed rate, mortgage rates should also keep dropping. And I know those spreads are a little wider than normal. So you'll probably see 5 handle on the 30-year fixed rate mortgage before the year is up. But again, in the context of where does price go? And we obviously don't. Neither of us have a crystal ball, but I tend to think price is still got a bit of a ways to come down. But no, good, great. Thanks for chiming in. Again, I have to cut it short at 5:30 today, folks, just because I have a family birthday dinner obligation, and we got to drive an hour over to St. Pete. So just FYI, I'm going to wrap in a little less than 15 here. Sick one, my friend, please. What are you thinking about?
Hey, how's it going, guys? Couple notes that I just kind of want to make over last year. So I'm going to just straight up say that I work for a certain media company, and right now, previously, they thought of themselves as more of a tech company, but now, there was a gigantic hiring freeze, but I don't think like the consumer defensives or the consumer side knows exactly what's happening right now, or there's gonna be like a major delayed effect with what's happening with the tech sector right now. So, but actually, I got a question for you, Rod, and anybody else that has more information on bonds. Essentially, we know last year both bonds and the stock market both fell together. What do you think bonds would be would still continue to go down with the current environment with what's been happening right now, or
So that's a really, really good question. Really hits the nail on the head, because I think that's where, when I get back to thinking about, you got to think about like what's priced in, what are the expectations, and generally speaking, bonds, especially treasuries, look pretty attractive in the context of how richly equities are priced. And you can get a risk-free. You could lock in, a 1-year treasury right now for, that's there's probably going to be some goofiness with this House of Representatives needing to raise the debt limit in a couple months here. So maybe the government's going to default on you. Probably not, though. But you can get a 1-year treasury bill, which for all intents and purposes is risk free. You're going to get a 4.7% yield, and I know the 2-year is a little bit lower than that. But like when I think about shorter term durations, you've then got to add an equity risk premium on top of those. And I think with how much uncertainty there is, I think that bonds are relatively more attractive than equities in the short run. And there's nothing wrong with hiding out in some government bonds. And like if you're buying an ETF, obviously you then have some different risks than if you're going to like straight up go to treasurydirect.gov and buy your treasury bills or bonds directly from the government. But like corporate debt, that you're going to get a little bit of a spread, of course, on treasuries. And I think that generally speaking, credit looks more attractive, I would say, than equity for 2023. And I'm going to be looking at trying to scoop some stuff up that I think is interesting. I personally use the it is an ETF that is a newer product that targets the 6-month treasury bill, and XHLF is the ETF, and you're going to pay 3 basis points, and you're going to get the 6-month duration, which the yield is like north of 4.5%. So obviously that's going to change over time, but that's how I have more than a third of my portfolio sitting in that right now. I'm trying to be patient. I mean, I could probably reach, find some longer dated. Once it's clear, and the market's obviously pricing in the Fed cut, as we talked about, but I think later on in the year, once it's really clear that rates are not going to be moving higher, if we believe inflation has truly been beaten, and that yields will come down, then you could buy some longer dated stuff and benefit from not only clipping your coupon, but also, an appreciation in the price of the bonds. So it's pretty clear with hindsight, of course, that bonds were crazily overvalued at the end of, QE infinity. And, folks who are short, I think I saw there was a hedge fund in the UK that was like levered heavily short UK gilts. And I think they went like 800% of their exposure, of their net exposure. It was some insanely levered bet, but they made like 160% short the UK gilt last year. I mean, that's not going to happen again this year. I don't think. Maybe in Japan there might be some interesting short bonds bets to be had. Like I think with generally, yeah, I would look to credit over equities in the short run, and there's nothing wrong with preserving your capital, especially if you're talking about very short term duration, 1 year, 2 year. If you look at equities and you think there's just too much uncertainty, you're not getting compensated for the risk you're taking, then there's nothing wrong with opting for the risk-free option, especially when there's a return to be had there, is my thinking at least. And watch markets rip to all-time highs next month because I said that, but hopefully that's helpful.
Sweet. Thanks for the info or the thoughts.
Yeah.
But also, yeah, like I also want to say from like my perspective, also what I was just talking about earlier, with what's been happening on the consumer side, not the tech side, wouldn't they also be facing like downwinds also? Because if the ball just starts to get rolling, like we have to wait for the ball to slow down and then it goes back up, doesn't it?
With regard to what on the consumer side?
Consumer market or the consumer sector. So what I'm trying to say is, so right now we're seeing like hiring freezes, pauses here and there.
Yeah.
Just a lot of nobody knows what the hell is happening right now. So like people are prepared for like the market to either go up or down or sideways. So, but what I'm trying to say is, how bad do you think the consumer sector is going to get in terms?
Yeah, I pulled up on the screen. So when you say the consumer sector, you got to definitely draw distinctions between discretionary and staples. And if you look at, over the last 3 years, roughly going back to the start of COVID, discretionary is only up 8% now, and staples are up 31%. And when you think about consumer staples, what we're talking about, Costco, McDonald's, etc. A lot of those consumer staples, I think, have been a flight to safety, where people have sought these really strong franchises that have very strong business models. But then it gets back to a valuation thing, and that's why I say, while I wouldn't be scooping up consumer discretionary right now, because I think the ball does slide further downhill before the bottom. I think that actually consumer staples, a lot of those staples, look like interesting, maybe short opportunities if you really think the consumer is going to be weakening a bit further. Like to me, it's a little bit crazy that something like a McDonald's, is trading near a 30 times forward earnings. I think it's like high 20s. Costco is another one that I don't currently have a position. I had made a little bit short Costco in the last few months, but if I look at Costco, we're looking at a 33 forward earnings, and the multiple is pretty extreme still. If my computer will load, I'll tell you. But I know for at least McDonald's, the forward enterprise value to EBITDA for McDonald's was about 20 times. So, McDonald's is a great business, great company, great model, but just like Costco is trading at 20 times right now forward EV to EBITDA, which is down, from the highest it got to, but still feels pretty rich. And I don't know that the returns will be that attractive. So I guess within consumer, I think a lot of staples plays have been flights to safety. people have most certainly not sold those off yet. And then within discretionary, that's where a lot of stuff is beaten down a lot, but a lot of stuff's probably going to go to not a lot of stuff. Some stuff's going to go to zero, and then the stuff that does survive. I think there will be a lot of interesting discretionary things in the back half of the year. So I guess that's what I'm thinking about in consumer broadly.
Okay. I don't have the numbers out in front of me right now, but what's the forward earnings for let's say like the consumer pharmaceuticals like Johnson & Johnson or Kraft Heinz, or something maybe like Kraft Heinz?
So J&J is a lot more attractive than McDonald's or Costco just in isolation on forward earnings. J&J is trading at 17.8 forward PE. You said Kraft Heinz. That's trading at 15.4. So yeah, I mean, again, obviously I'm making broad statements about sectors, and within the sectors, there's certainly culprits on every end of the spectrum. So I would, in a nutshell, or not in a nutshell, I would, just looking at that one metric, say, yeah, those two, J&J, Kraft Heinz, I mean, both not going anywhere, but more attractively valued than, say, Costco or McDonald's. Are those things you would pair? I don't think so, but there might be interesting things to look for on like a relative valuation, where maybe you go long the one that's you think more attractively valued, and maybe you short as a hedge the other one, or whatever. I mean, obviously there's a variety of different ways that you could construct a portfolio, but yeah. But hey, it is 5:30, and I know I didn't want to have to cut us off if we got a good conversation going, but I do have to get in the car and drive, and unfortunately I cannot sit at my computer and continue the presentation while I'm doing that. So we're going to wrap it a little early today because I have that obligation. But thank you everybody who did tune in to this, our first look and review of 2023. It'll be very interesting to see a year from now how the 2023 expectations played out. If we do experience this mild recession that seems to be the consensus, or if there's something not so bad, or if there's something worse. We'll keep monitoring. We'll continue to stay abreast of the Fed throughout 2023. We will continue to broadcast the Fed press conferences after each FOMC meeting. And as I mentioned at the onset, we will continue to hold our monthly book club. We'll do that at the end of January on Tuesday night at 8 o'clock Eastern. So every Tuesday at 8 p.m. is the tentative schedule, last Tuesday of the month. We'll be doing our book club. We're going to cover Seth Klarman's Margin of Safety this month. And we will be back next week. Joe and I will keep hosting our weekly market open mic calls Wednesday nights. We've had some of those get over 100 or so people in there, and we've had some good conversations. This week was pretty slow, which I kind of figured, being right back out of the new year, but we'll be back Wednesday night with that. And then next Friday, of course, with next week's Wook in Review. And I'll have some fun news to share on what we have cooking up for earnings season. So thanks very much, everybody, for tuning in to this, our first Wook in Review of 2023. We sincerely appreciate your interest and engagement, and we'll talk soon. Cheers, everybody.